We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Christopher Aaron, founder of iGold Advisors and Elite Private Placements. How are you today, Christopher?
Doing great, Tom. Thank you for having me on the show very much.
Great to speak with you again. So you recently released an update on your YouTube channel, and you started by talking about basically the high inflation that we've been seeing and how it's being treated by the precious metals market. So why don't we start there and we can kind of go down that road?
Yeah, I think this is a totally critical narrative for people to be grasping right now. There's been a strange paradigm in these markets that we follow, especially the commodities and the currency markets. This has really been going on for the last 6, 7, 8 months here. I've been watching this almost on a daily basis, where anytime there has been a fundamental news piece, let's say an inflation report, or let's say a manufacturing report, a producer price index report, anytime you've seen any of these fundamental news pieces come out that have been supportive of the economy, so the economy is turning, wheels of industry are turning, or inflation is higher. Anytime you've seen supportive news pieces for inflation, we have seen the inflation-sensitive assets, and especially the precious metals, do the exact opposite of what one would think that they should do, which is to sell off. So, and I'm telling you, you can go back to inflation reports, the US here, the CPI reports that have been coming out on a monthly basis, and whether or not those reports are below the median analyst expectations or above the median analyst expectations, you can basically dictate how gold is going to trade based on whether the report is higher inflation than economists were expecting or lower. And the key is that it's been happening in the opposite direction. So when we've been seeing the high inflation reports over the last 6, 9 months, we have seen gold immediately sold off, silver sold off, the gold miners sold off, and we've seen the US dollar go higher whenever, if you think about it, the fundamental news is devaluation of the US dollar. I mean, that's what inflation is, devaluation of the US dollar, and then you see the dollar rising on that news. So it's been perverse backward, and the logic that has been really embraced, it's sort of a logic that traders have been keying off of, is that if there is high inflation, then therefore the Federal Reserve and other central banks around the world are going to act in the future. Maybe at the November meeting coming up, maybe the December meeting, they're going to do something. So therefore, the higher inflation is, the more we should sell our inflation hedges, of which gold, if you study history, go back to the highest inflations ever witnessed in the history of mankind, the hyperinflations of Weimar Germany. Gold tends to be the premier inflation hedge in those times. Gold has been sold on the high inflation here over, the last year plus or minus. So the key is, this is all the narrative. The key is that on Wednesday of this week, when they release 5.4% CPI inflation, 5.4% year over year price increases, we did see gold take that initial $20 dive as soon as that news was released. I'm talking $20 lower right at 8:30 a.m. And then it stopped on a dime. New buyers stepped in and bought it, not just back to where it was, but in fact, $20 above that previous entry point where the sellers had showed up just half an hour prior. So clearly, I mean, you had some traders believing that rumor, that myth, but I was watching it in real time and I say, someone else is coming in here and they're saying, hey, there's only so long that we're going to believe that high inflation is going to equal low inflation. I've been waiting for this, for this turning point when it's all psychological. I've been waiting for the turning point when the market's psychology was going to shift And it appears that we saw it on Wednesday. So not to say that gold has to move straight higher from here, but it was very positive to see a new group of buyers come in, after those irrational sellers were doing their thing.
So how do you ultimately, let's say, analyze inflation? What details are you looking at to inform where you think inflation is headed, and does it ultimately matter for you in the bigger picture?
I'll answer the second part first, which is the numbers ultimately don't matter for me, because I tend to be a technical based trader. And so the bottom line that I'm concerned with is the price of whatever asset it is that I'm investing in. We could have, and there have been examples of this, you can have moderate inflation. Take the 1980s and 90s. There was certainly inflation. I think there was only one recession in that period, one or two quarters of recession, 87 and 91. But aside from that, you had pretty steady inflation the entire time, 3, 4, 5% inflation. What happened? Gold was lower for 20 years. It's all psychology, because there were other draws. Investors were keying on technology stocks and whatnot in the NASDAQ bubble. Ultimately, I don't care about the news headlines. Ultimately, I care about the price of the asset. Let's talk about gold or the particular stocks that I am investing in. All I care about is do those go higher? Do those go lower? If we want to talk about the fundamentals, though, we could. The CPI report, the Consumer Price Index report, is a measure of inflation. It's sort of like taking a temperature, if you have a fever and saying, what's your temperature? Oh, it's 101. The thermometer, the thing telling you that, is not the fever itself. The thermometer is not the problem. The CPI, the high CPI, is not the problem. That's the symptom. Mm-hmm. The problem is the debasement of currency overall, especially since the coronavirus panic started a year and a half ago. And we could say that, okay, perhaps they needed to do something to help millions of people that are thrown out of work. I agree. We don't want people starving on the street. We don't want people living on the street. However, aside from really the bare necessities of maintaining human life, I think most of those measures that the central banks have taken consistently, not just in the last year and a half, but it's really all the chickens coming home to roost. Especially since the crash of 2008, I think it's all of that inflation. You look at the Fed balance sheet. That's another good way you can measure kind of the underlying inflation. It took in 2008, the Federal Reserve had a balance sheet of just approaching $1 trillion, meaning it took them almost 100 years of existence to quote unquote print, or the electronic creation of $1 trillion. And from 2008 till now, you've got their balance sheet up around $10 trillion. So, a tenfold increase in the last 13 years. That would be another way we could measure inflation. You can look at all the M1, M2, M3 statistics. Ultimately, though, those are all interesting to know, but I like to bring it back to what impacts me, or what impacts you as an investor. It's the price of the thing that we're talking about.
Mm-hmm. So kind of in that same vein, Christopher, when we get news like the employment numbers or consumer spending numbers that give us these swings in the gold price, are these signals something that need to be basically ignored as noise and refocus on the fundamentals, exactly as you were just saying, what's actually affecting or which way the market is actually heading?
Unfortunately, no. Even though they can be noise over the short run, indeed, I do not think they should be ignored, because if you break sometimes certain key support levels in a market, for example, I am looking at rather significant support for gold down around 1675, going back here for almost the last 2 years. For example, if some of those short-term noise, irrational trading individuals or entities whether nefarious or not, whether they're manipulators or suppressors or legitimate traders, which it's all of the above. But ultimately, even if that type of selling causes a support level to be triggered, you can suffer some real damage because you flush a lot of stops. There's a lot of traders in at certain levels. They get flushed, they sell, it creates a cascade effect. And, the entire mining industry is keying off the spot price of these metals, whether there's a lot of paper manipulation in there or not. And so real damage can be done. So I like to follow these technical levels. But if it's within a certain range, kind of tune it out until we break higher or lower from a certain range.
As you're exactly saying, this range, if we break out of this range, it kind of signals a change of psychology in the market. So how do you feel that sentiment has been in the precious metals markets, and how have you learned to deal with your psychology and your reactions to this market at times like we've seen for the past several months?
Sentiment in this sector has been piss poor, if I can use that language, or I'll just say it's been horrible if we need to phrase it another way. It's really been horrible for easily the last year. And it's up right until Wednesday of this week. So just the last 3 days. And I, as someone who has a business who is engaged in buying and selling assets related to precious metals, related to commodities and currencies, I can see, first of all, I can only see what everyone sees as far as the market data, but I can also see things that some people don't have access to as far as investor sentiment, number of people joining, number of people canceling, number of people sending me emails saying, I'm sick of this. I'm moving over to cryptos. I'm moving over to the energy sector. Uranium is where it's at, and I can tell you that I have seen this type of sentiment before, and sometimes it can last a little bit. Sometimes it's like you're feeling this negative sentiment for 6 months, 9 months, a year. It seems like this can't possibly go on. And then it goes even lower, right? It goes on another, maybe even 6 months. You get a total washout. It's tough to say where exactly we are. I will tell you, it was close to as bad from a purely subjective standpoint. It was close to as bad as I have witnessed in, 15 years of following the precious metals markets. It was close to as bad as I've seen just about a week ago. However, as far as strategies that I use personally, one of the most important things is I believe there are companies that can succeed in any market, even in a stagnant or even in a downward market. You have to be much more particular. In a downward moving market, you have to be very careful of the companies that are purely leveraged to the underlying metals as basically the entirety of their business model. If all a company is doing is, let's say, producing 100,000 ounces of gold at a cash cost of $1,000 an ounce, and they have no growth and no discoveries coming along, that company is going to move 2 or 3x the price of gold up or down. And if you're in a stagnant or downward kind of market, you have to be careful of that. Those companies can get really hit. However, if you're looking at companies that have the potential, let's say, to make a bona fide new discovery, or to materially advance an existing deposit over 6, 12, 18 months, even a stagnant market can be, even a sideways price action for gold itself can be very supportive for a company that's putting drills into the ground and finding something. As long as you are careful, this is the key. As an investor, you have to not overpay for that opportunity. If a company has already doubled, tripled, quadrupled off of its recent lows, and you're just getting involved then, I think there's too much risk. So personally, I look for the companies that are really just rounding off the bottom. And in a market like this, there are a lot of those. And I think then you can go into those companies as long as you diversify properly. You get a couple hits. You know what I mean? It's like the baseball analogy. I mean, we're in the playoffs right now for baseball here in the U.S. Go Red Sox. However, you don't need a hit every single time you're at bat to be an all-star player. If you could get three out of 10 that are multi-baggers in this sector, especially if you're doing it, let's say, with warrants, which is what we do in elite private placements or some other private placements that are available in this sector, you can really stack the odds. You can really change the value of your entire portfolio just from those few hits or those couple of home runs, even if the market itself is stagnant.
Mm-hmm. So as we think about human behavior and psychology, you have some interesting notes about that on the GDX chart. So can you share your screen with us and kind of walk us through your analysis on that chart?
Yeah, let's do that. All right, here we go. So what we're looking at here, Tom, and to everyone who's watching this, is the GDX. This is the Senior Gold Miners Fund. Here in the U.S., it trades in the U.S. This is, large cap gold miners. It has about a 20% exposure to the silver sector as well, I should say. But pretty representative of those companies that are more or less directly leveraged to the metals. In other words, you don't have a ton of organic discoveries happening with these GDX companies. You have leverage to the price of the underlying metals. So we're looking at the last year and a half here, almost 2 years. Here's the panic in the coronavirus. Here's the recovery. This level in here by the black double line around 31 to 32 was a critical resistance. This going all the way back to 2016 was the peak in 2016. And then it took a few years to get back to this point. We finally broke out of this level right here in April of 2020 after things settled down from the coronavirus. And if you look at the number of times here that this level between 30 and 31 has acted as support, if you look where my mouse is right here, it has acted as support back in April of 2020, support again here in May, support again here in June, support again here, February, March of 2021, support up here in April, support in August, and again in September of 2021. So this is what you would call a real key level of support for the entire gold mining sector. And you have to believe that the companies that are mining for the metal are, in fact, their valuations are going to be closely tied into the future expectations for the price of the metal itself. And so what we can see here is going back to September, just about a month ago, this fund broke down. It actually failed to hold the support level at around 31. It failed for about 3 weeks here. But something very interesting has happened, which is that not only has it broken what was a very clear downward trend of sellers for the entire sector, but it has also recovered that former support. And in the type of technical analysis that I focus on, this is what thus far, even though today was a slight down day in the metals, thus far, this kind of thing where you have a clear support level, you break down, but then you recover this support level, this is what we would call a false breakdown or a capitulation breakdown even. The last time I've seen something like this, and when I say capitulation, I'm talking about the sum of gold mining investors. If we switch down here and look at the gold chart itself, and you look at the relative support, this black double line, you notice how gold was still, it's been weak. It's been kind of grinding, but still well above that year and a half support, whereas the gold miners had dropped below that. The last time that we've seen this sort of false breakdown or capitulation breakdown, which is really it's a gauge of sentiment. You're looking at these gold mining investors were just getting so apathetic and so frustrated with this lower to sideways grind in gold that they just said, I'm done with this. They broke that support, but thus far, as we're speaking today, here on the 15th of October, thus far, that appears to have been a capitulation move. And when you see those capitulation false breakdowns after a year and a half of grinding consolidation, ironically, that actually tends to be one of the most bullish signals that can be observed across any market, whether we're talking general stock market or gold or stocks. Because when you see capitulation, it's telling you the last of the sellers who would sell have sold. Mm-hmm. And when those final sellers have sold, there's no other sellers to sell. And when there's no other sellers left to sell, the only thing that can happen is for prices to go up. So that's why, these capitulation moves, if in fact that proves to be correct, look, nothing is guaranteed. A market certainly could round up and back down. So we would have to watch in the future. Does this level around 29 get taken out to the downside? Mm-hmm. It can always happen, but thus far, what we're seeing is a very bullish capitulation type reversal here for the entirety of the gold mining sector.
And as you said, it's kind of marking hopefully a change in psychology in the metals markets, right?
One would certainly think so. That would be the thesis. That would be the operating thesis here for the entirety of the sector, which would then trickle down to gold itself, trickle into silver and the silver miners as gold tends to lead. And then you would also be talking about this really being supportive of the rest of the hard assets, the rest of the tangible commodity sector. If this is going to be a major multi-year low, then the rest of the hard assets are going to be performing well. Everyone will move at a different time in ebbs and spurts, but this is a really good backdrop to be seeing.
Mm-hmm. So, Christopher, you tend to look at charts over a fairly long-term time basis. Is this to kind of give you more perspective, or is it to remove noise? Why do you look at most charts over a fairly drawn-out time perspective?
Yeah, you have to put the big picture in perspective. It's it's important to remember where we are in the big picture, where we are going, where we have been. Is something a short-term top versus long-term top? Is something bottoming after, just a short-term decline, or could this be a major multi-year low? You need to know that. It's situational awareness. So that's why I do that. I tend to start with the big picture, try to keep that in my mind most of the time as a backdrop. Mm-hmm. But day to day, I focus on, this is the time frame that I focus on day to day. Let's talk it like a 1 to 3 year time frame. You would call that like the usable intermediate term time frame.
Perfect. Why don't we move on to the next chart, the Dow to Gold Ratio chart? And with the Dow somewhat rolling over, is that becoming favorable for capital to flow from let's say the Dow index into gold?
Yeah, this is going to be one of those long-term charts that we talk about, and that is really important for situational awareness. We are looking at the Dow to Gold Ratio, 1976 through the present. Basically in the freely traded era for gold, once gold was allowed to be owned by U.S. citizens, that was only in 1975. So, you're 1 year beyond that here. Obviously, for anyone who's new to studying these charts, important points to remember. The higher this goes, we are looking at a log scale, which is why these numbers get crunched up in the top here. That helps us to see bottoming price action more clearly. The higher you go in this number, the more the Dow Jones Industrial Average is outperforming gold. The lower you go in this number, the more gold is outperforming the Dow. Critical points. This down here, 1980, the ratio hit 1 to 1. What is the Dow trading at right now, Tom? Do you have that in front of you?
I can pull it up real quick. 35,294. Right.
So thank you for that. So if this level were to be hit again in 1980, that would mean gold trading at $35,000 per ounce. And that did happen in the past. Not only did it happen in 1980, it also happened in the year 1933. Both the Dow and gold met at roughly 35 during the depths of the Great Depression. So there are two data points to support this thesis happening again at some point in the future. And remember, that's not like a hyperinflation number. I mean, so this happened in 1980 with gold at 850 per ounce and the Dow at 850 per share of every company in the Dow Jones Industrial Average. It's not like the currency was being hyperinflated then. This wasn't pandemonium on the streets. Yeah, the stock market was stagnant and gold was doing really well, but it wasn't the end of the world. So from where we are here with gold just below 1,800, for this ratio to work its way back down into the region of 1 to 1 would mean gold going to roughly 35,000 per ounce in, slightly depreciated dollars, but still usable US dollars. Conversely, when you look at some of the peaks up here around 45, 46, this was the peak from the NASDAQ bubble in the year 2000. And so you had, people buying, pets.com, bubblegum.com, everything under the sun, and paying absurd valuations for those stocks that had no earnings whatsoever. And it resulted in an extreme overvaluation. This is the highest the ratio has ever been. Mm-hmm. So here in this 45-year chart, you're looking at the lowest the ratio has ever been in favor of gold and the highest that the ratio has ever been in favor of stocks. Right now, we're somewhere in the middle. We're just below this 20 level. But it's a really interesting point from a trend analysis perspective. You can see very clearly, you look at these blue arrows here from the peak at 45, 46, down to these secondary peaks in the year 2000, 2001, all the way fast forward to 2018. Isn't it amazing how a simple trend on a chart, boom, it's like the market stops dead in its tracks on a trend that started 15 years prior. This is why I love studying this stuff from the technical standpoint. And so look at where we are right now. Look at the blue arrow here right now. We are once again at this trend. The rule is the trend is your friend until proven otherwise. So what this argues is that we're in a window here, and I think we're starting to see evidence for that already. We are in a window here where it is time for gold to start outperforming general stocks, the Dow Jones, the S&P 500, even the NASDAQ. We're in a window. I would expect this ratio from under 20 to basically be rolling over. And you can see, previous times that's happened, it has not always been just one data point like it was in 2018. Sometimes the rollover can be a bit of an affair. It could take a year or two. But the message here of the chart is telling us that we're in a window of the next 6 to 12 months where gold should start outperforming stocks. So I think what this ratio is telling us is that we roll over here and then we come back down. Now, what's going to be really interesting is we're going to come down. I know my mouse is small here, but I hope you can see it. I'm moving it around here. We should be coming back down to an even longer term, somewhere in the 13 region, an even longer term rising trend from that 1980 bottom level. And so what you have here is this triangle shape that's converging. You're getting, whereas it was very extreme for the first 20 years of this chart, you then had a lesser bottom, a lesser peak, a lesser bottom, a convergence here. So I think we're in a window where probably now through mid 2023, I think gold is going to outperform general stocks as this chart comes back down. And then I have to take a step back and say that I'm going to be agnostic after 2023. When we come down to this level, I'm going to kind of take some of my profits off the table on gold and basically step to the sidelines and watch, because whichever direction this breaks, and I can't give that forecast until I actually see it, but I will be watching it very closely. Whichever direction this breaks, whether it's upward in favor of stocks or downward in favor of gold, whichever direction this consolidation breaks is going to dictate the macro landscape for really most investors, basically from the mid 2020s, I would argue well into the 2030s. I think we're going to have something like a 10, you look at some of the previous swings here, a 10 to 20 year either bull market in gold really shaping up, or stagnation in gold and continuation of bubble-like valuations, perhaps to an extreme that we have not witnessed before in stocks. Mm-hmm. So I think you've got about a year and a half to 2 years solid move here setting up in gold, and then investors need to really watch this carefully.
Yeah, excellent point there, Christopher. And like you say, we're really kind of coming towards this a decision point to break either one of these trend lines.
Yeah,
and very long-term trend lines.
Super long-term, and the longer and the trends are so, if I could use the word symmetrical, coming in here to this symmetrical triangle, from someone who likes to study the visual aspects of these charts, these are almost, picture perfect trends to be watching here. Mm-hmm. I mean, the longer term that a trend is, the more important it is when you get a legitimate long-term break. And you can see here, sometimes you have, this, for example, this magenta colored trend is a best fit trend. And so you can see when you go best fit from the absolute lows through some of these bottoms in here and through that bottom, what ends up occurring here is that this 2011 low was a little false blip, right? So you have to watch out for that. Anytime you see a little false blip like that, this kind of gets back to that point we were making about the GDX, Tom. Notice little false breakdown here on the Dow to gold. What? Springboard higher for the next 10 years in the opposite direction. So that could be setting up with the GDX and the gold mining sector now as we're speaking. But back to the original point. So when you're looking at 40, 20, 30, 40 year trends, you need to give those trends some weeks, especially even a few months of closes to really seal the deal on whether that trend break is legitimate. If you see, if we saw a 1 day pop in the ratio above 20 here, I wouldn't place too much weight in that. We need to, for long-term trends, we need to give that some time.
Yeah, great point. So let's move on to the US dollar.
What I would like to do is look at the last 15 years or so of the dollar. In fact, I can go, let's see how far out I can go with that. That's weekly. So we can get like a 20-year perspective on the dollar. I have not annotated the whole left side of the chart because when you go from 2002 through 2008, you had a very clear bear market in the dollar. And there was a clear shift here from 2008 in effectively what was a bottom in 2008 and almost a functional double bottom here in 2011. Are our videos here covering up the chart axis? Let's see. If I do that, maybe that'll be a little better. Okay. So you have a new trend. So that's why I'm going to zoom in here on the last 13 years or so of this chart. And we're looking at long-term trends. These are decade-long trends, decade-long rising resistance here. I mean, look at these data points. The fact that you have 1, 2, three peaks lining up here for resistance is telling you something. It's telling you where those sellers are showing up. And then if you look at the lows, for a long-term trend like this, you don't always have to start at the exact absolute low. When you have a functional double low, the trend will often begin with the second data point representing that double low or the functional double low. And so what you have here is a 10-year rising trend. And what I like to do, the longer the trend, the less likely it is that you're going to have precise hits on the trend line where it's going to come right to the point and then bounce exactly that. That would be a little unrealistic given that we're talking about the sum of human behavior here for the world's reserve currency, right? So what tends to happen when you have these long-term charts is that you get a slight fanning out of a support zone. Just the same here where you can see in the black when you look at these swing peaks, the peak up in here at 89.5, the peak right here at at 88.5, and then some of these peaks right in here at 89.5. A bit of a zone right in these peaks. Same thing for a rising trend in support of the fiat currency, the US dollar. So you have a slight fanning out. So I show a best fit line here in the solid color and an absolute lows. If you take the absolute lows of the trend, you come in here to this trend. The big point for the dollar is this. Either way, this decade-long rising trend for the dollar is broken. Mm-hmm. And not only is it broken, it's been broken now for almost a year. And every retest of the trend, look at where the rejections are coming in here. The dollar, notice after we broke the this fanning out magenta zone here, look at this. You come down to 89, rejected right there at 93. And so what's happening here, this is real classic type of technical analysis where you will have a broken trend, which we still have. Mm-hmm. The market has simply not began its declining phase yet. So if I move that a little bit and let's zoom it out and kind of do this, and you want to ask me what's happening here with the dollar, it looks like the dollar is in sort of its last gasp, where we are getting a series of failing tests to recapture the rising nature, the bull market in the dollar. It's failing multiple times here. I'm not making this up. You can see it, Tom. Mm-hmm. I can see it. The people who are watching this video can see it. The dollar is not recapturing either one for any sustained basis, either one of these rising trends that go all the way back to 2011. And so, when we're talking about a 20-year chart here, it's very normal for a chart to sort of need to bounce like this in no man's land for 2 years, 3 years, 4 years. And then after that happens, the final piece of this puzzle is to see this black support level broken to the downside, which is then what starts, in our view here, the real bear market in the world's reserve fiat currency. Mm-hmm. And so it is no coincidence for those who are following other aspects of the hard commodities, the tangible commodities, the hard assets. It is no coincidence that we appear to be in the beginning stages of bull markets in uranium, in natural gas, in oil, in platinum, in gold, in silver. What else? I could even say in real estate, outside of the bubble markets. You have to be careful for those cities that are, frothy with a lot of unsustainable buying going on. But real assets, tangible assets as a whole, as this dollar chart is going to be rounding down over the coming decade, this is not a short-term prediction, but real assets, when we look across the board at all those commodities, they appear to be in a process of rounding upward right now. And I would argue, there's a lot of people that have had some good gains here in the uranium sector, the energy sector over the last couple of months. Don't forget to take profits at regular intervals. That is key. And also look to do some rotation, perhaps every 1 to 3 years in the commodity space into the sectors that are currently unloved. Because it appears here that as the fiat dollar is sort of entering a bear market, which is going to have fundamental reasons. It appears to be that all that inflation is not going to be able to be contained, as the Fed claims. I would just say to people who have had some good gains, remember to take profits at regular levels. No one ever went broke taking profits. Mm-hmm. And then try to reinvest, not in the companies that have already doubled, tripled, quadrupled over the last year. Go for the companies that are just still basing along the bottom, as long as they're fundamentally sound companies, and try to multiply your wealth over time.
Yeah, just one last note there, Christopher, as you were saying that we've basically broken that trend, and now that support trend has acted as resistance, right?
Absolutely correct. And that is again, it's classic technical behavior for a market. It doesn't matter if we're looking at a currency market, precious metal, an individual stock, fill in the blank. If you like to study this kind of thing, which I do, which is what led me to place a foremost emphasis on the study of the actual patterns in the markets. But if you like to study this kind of thing, you will see this type of price behavior across so many different markets, across so many different time periods, where broken support turns into resistance.
Excellent. So you've just launched a new service called Elite Private Placement. So why don't you tell us a bit about that, and can you share with us some tips about how you look for the right deals, the proper deals to be investing in, at a time when, as you were saying earlier, that we've really kind of been going sideways here.
Yeah, thanks, Tom. I'll tell you, I'm really excited about what we've put together here and what's coming together. This is really the culmination of my experience as an investor over the last 15, 20 years. And it's putting together the technicals and the fundamentals, as well as negotiation with individual companies. So what we do, we've got a group of investors that have come together. I would say, as a backdrop, this is more appropriate for higher net worth investors. You have to have a certain level of disposable capital where you can diversify it into enough of these placements where if one goes down a little bit, you're not going to freak out. Because, back to that baseball analogy, you take enough swings, and if you get the process right, you're going to get a few that really hit. And those that hit totally change the trajectory of your overall portfolio.
Is that only open to accredited investors?
The official rules in Canada state that investors need to be accredited in order to participate in these deals. That is what the rules state in Canada. I will say that I've not witnessed that verified when we do it. But the bigger picture here is that investors need to have the minimum for each of these investments is about 10,000 Canadian. And investors should have enough disposable capital that they could do at least 5 of these over the course of a year so that they're diversified enough. And where it is not going to cause them worry if one oscillates a little bit before our thesis takes hold.
Right.
Those are the official rules. Yeah. So what we've done here is we have a good group of investors that we already have on board. And we bring these investors together and we approach companies that, by focusing, how do we focus on these companies? How do we find them originally? It's myself and a couple colleagues, most of whom are based in Canada there, but we analyze them foremost from the chart. We look for companies that show favorable basing patterns, companies that have been under the radar screen, companies that have not already doubled, tripled, or gone up 10x over the last year or two. We look for companies that have sound fundamentals. we speak to management, we do research on the companies. But the most important thing, and this is where I see this every day, we will go invest in a company, let's say. We'll put $1 million or $2 million into a company collectively with all the investors that we bring together. We'll be getting in at an entry-level price. I'll see some of these companies do well, let's say the share price doubles or triples over the course of the next year. A year later, this company will have no problem raising $5, $6, $10 million, right? Once the share price has already doubled or tripled. And so I'm saying to myself, why weren't these people interested when the share price was a third of what it was, when we were getting involved? To be totally upfront, I have a rule. I don't buy companies that have already tripled or quadrupled over the last year. I just don't do it. But
Back
the
to
fact
that
that the
psychology
companies,
piece, right?
exactly right. And the fact that the companies are able to raise multiple more money once their share price has already risen is telling me that most investors are, I'm just going to say it, most investors, I'm not saying you or anyone at Palisades, and I'm not pointing out anyone in particular, but I am saying the sum of investors are getting it wrong. And the proof of that is the fact that these companies are able to raise multiples more money once the share price has already skyrocketed. So if you stay away from those investments that have already shot up and you focus on the sound companies that are not being paid attention to, that helps you really stack the odds in your favor. And then what we do with some colleagues is once we have the commitments from the investors, we know we can raise $1 million or $2 million here. We go to the companies and we say, look, we're in a down market here. We're all feeling that, the metals have been languishing. Psychology is bad in the markets. We want to help you guys advance your gold deposit. But we want a nice warrant with it. And for those who are not familiar with warrants, we're talking about, these are contracts that give you the right, but not the obligation to buy more shares in the future. So they are highly leveraged instruments. The key is that when we're coming together and supporting these companies, helping them to basically stay alive and keep their deposit growing, these companies will give us warrants usually for free, for absolute free. And you do not get warrants whatsoever if you're just buying shares in these companies in the open market. So you bring those multiple things together. You look for charts that are just basing as a backdrop. You then get a group of people that are negotiating with management with these companies. And then you get really strong terms with the warrants, which basically double your upside in these investments with no additional significant risk, other than each one of these investments you have to hold for a minimum of 4 months. That's really the one downside. So these are not appropriate for short-term trading. Aside from that, that's what we're doing. We have a growing group of investors coming together. We're looking to finance companies over the next year. I suspect within 2 to 3 years, once the commodities really start taking off, I suspect that companies will not be offering warrants in the future, because everyone will be like, yeah, I want to buy gold. I want to buy silver mines. Right now, that's not the case. So investors have an opportunity right now to get in at advantage terms. When everyone's talking about it a few years from now, that really won't be the case.
Excellent, Christopher. So last time we spoke, you talked about the anti-fiat education that you have received. So how has your perspective changed on the fiat and, let's say, by extension, the Fed and the Treasury system since then?
Yeah, I'm going to say it's something that I'm really, really passionate about. Overall, I am passionate about this idea of a sound currency being essential to human liberty and human advancement, all of us as a species. And there are just multiple ways in which an unsound currency, you look at the CPI inflation statistics, right? 5.4% debasement in the currency in the last year. that starts to get tough on savers for people to put away money. One of the definitions of money is a store of value. I would say that if currency is losing 5.4% in a year, it's not really serving as a store of value at this point. So that throws a lot of aspects of the way that we live and work day to day. It throws a lot of that on its head. And I just think people need to remember that from the big picture perspective, the founding fathers of the United States specifically warned against allowing a private institution or a consortium of private interests, which are what make up the Federal Reserve. They warned about not allowing those interests to take control of the printing press. You know, that if we allow that to happen, our children are going to wake up homeless on the continent that our forefathers fought for. And if you look at how, since 2008, the share of wealth that has been redistributed through all these Fed programs, central bank programs, you look at the top 1% that I don't have the stats in front of me. You know, we could pull up that chart perhaps somewhere on the internet, but I think it's somewhere like the top 1% of the society has gone from owning like 40% of the wealth in the country to 60% over the last 13 years, as the Fed has been printing all this money to help people. Right. Well, really, it's been accumulating that wealth in the hands of those that probably don't need it as much. You know, another thing that that I'm quite vocal about is the effect that a central bank has on allowing nations to continue to fight wars that are unwinnable. You know, this is something that I did in my former career. Being in Afghanistan, I saw with my own eyes the amount of waste that was happening overseas. I saw, being on Bagram Air Base in 2008, the tankers of oil coming in constantly, the food coming in, the planes taking off, the bombs blowing up, the taxes that we were all having to pay to do that, or the hidden taxes through inflation. And then not only that, not only the taxation on one side, but the destruction of the wealth on the other side of the planet, right? A double destruction. Orwell talked about this, that war, when being financed through central banks, is the only form of double inflationary destruction that we as human beings take part in. I mean, I'm not a socialist, but I'm compassionate toward people who have less. We've all gone through hard times in our lives, myself included, back, in the last decade. And so that said, if we were going to print a lot of money or inflate the currency, I would much rather that go toward actually helping people. Medical care, food, housing, right? Mm-hmm. At least that would do something for us, as opposed to a 20-year unwinnable campaign of blowing stuff up on the other side of the planet. So a key point, central bank is the funding mechanism for that policy of unwinnable warfare.
Mm-hmm. Yeah, kind of to your point, I was reading an article the other day that before COVID, I think there was only one person that was worth $100 billion. And now I believe there's 10 or more. So, it really makes you wonder how these policies affect the super wealthy, as you were saying, and maybe the people that do need a helping hand. It's not necessarily always the policy that looks like it's going to help those people always does, right?
Yeah. And I think it's actually one of the famous plays from the playbooks of politicians and central bankers to promise constituents goodies from the public treasury, and to give little carrots, little token amount of trinkets and goods but to have the vast majority of the redistribution of wealth happen in the opposite direction, away from those people that are trying to vote for something to help them. It actually hurts them.
Yeah.
Prime example of that is inflation, right? The CPI inflation, food, energy, everything that people need to eat. They say the poor have to spend a much higher percentage of their core income. The poor have very little disposable income. So if you have to spend everything you have just to get by, and those prices are going up 5-10% every year, it's the wealthy that benefit from inflation. And so for people who are on the line, if you have some disposable capital, the thing is to realize that you're kind of on that precipice. You're at that point where you can start being on the receiving end of the benefits of inflation. But you really have to act in the right manner, because if you let yourself get taken down in one of these, deflationary busts or panics that we have every 5 or 10 years, then you're receiving the hurt from the inflation. You're not receiving the benefit.
Yeah, and it almost seems like we're in a stagflationary environment currently as well, because while the cost of all of our living expenses are going up, I don't know anybody that's gotten a raise in the last year and a half, right?
Yeah, it's crazy. I've been removed from the corporate world for quite a while, so I don't have my finger on the pulse of how raises are going or whatnot, but I can imagine it. I can certainly imagine what you're saying. And if you've heard that from people, I imagine that's wider spread than just the people that you're talking to.
Excellent, Christopher. Well, do you have anything else you'd like to share with us before we wrap up here?
Yes, this is the time. This is the time to prepare the life raft, the vessel to weather the storm that the charts show us is brewing. That dollar chart may have another year or two to hold up, best case scenario. But that break of a 10-year trend, which is failing to recover it, is a sign that there's trouble for the dollar later on this decade. We look at the inverse of that. You look at the movements in the commodities here in the last 6 months or so, looking quite constructive. And then I would just say go back to that very first chart we looked at, the GDX. It's kind of looking like sentiment just got so lopsidedly negative for no good reason, just apathy here over that sort of irrational selling of the inflation sensitive assets on the high inflation figures. It looks like that happened to the extent that we have a nice reversal here in the GDX, which if that holds, let's watch for it. But if that holds, we should have a nice tailwind at our backs across the precious metal spectrum.
Excellent. Well, Christopher, you're available on Twitter at iGlobalGold and iGoldAdvisor.com. Anywhere else you'd like to point people to?
No, that'll be it. They can find me in any of those spots.
Excellent.
Thank you very much, Tom.
Thank you. Thanks for your time and your sharing your perspective with us today.
All the best to all the listeners.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.